One of the most common things we hear from new clients sounds something like this. They tell us they were told they could take losses from a deal against their W-2 income, or that those losses would offset active business income they already had. And in most cases, that belief wasn't malicious. It wasn't the result of someone trying to mislead them. It was optimistic. It was based on how the strategy was described, not on how the rules actually work in practice. Material participation is one of the most misunderstood and most misrepresented areas of tax advantage investing. Not because the rules are unclear, but because they're inconvenient. They don't map cleanly to how most syndicated investments are structured. They don't bend easily to good intentions. That disconnect is why so many investors are surprised later, long after capital has already been deployed. Material participation is not about intent. It's not about how involved you feel. It's not about what you were told would be tracked on your behalf. It's about control. The tax code doesn't ask whether you like the deal, believe in the mission, or attended a certain number of calls. It asks whether you materially participate in the activity that generated the loss. That participation has to be real, continuous, and defensible. It requires decision-making authority and operational involvement, not passive oversight. You don't get credit for enthusiasm. You get credit for responsibility. And that distinction is where most people get tripped up. Because the way material participation is described in marketing often has very little to do with how it's evaluated under scrutiny. In most syndicated fund structures, investors are passive by design. They don't control day-to-day operations. They don't make pricing decisions. They don't direct execution. That isn't a flaw in the structure. It's the point of the structure. Centralized control allows the sponsor to operate efficiently and scale decision-making, but that same feature makes substantiating material participation extremely difficult. Tracking hours doesn't change that reality. Attending quarterly calls doesn't change it. Reviewing reports, responding to emails, or participating in occasional discussions doesn't change it either. If you don't control the operation, you don't control the tax outcome. And when losses from those structures are claimed against active income without that control, they become vulnerable. We often hear claims like, everyone in the fund materially participates, or we have systems in place to document participation for you. Those claims misunderstand how the rules actually work. Material participation is fact and circumstances driven. It cannot be assigned, it cannot be elected, and it cannot be manufactured after the fact. Grouping elections don't create participation. They only aggregate activities that already qualify. Documentation can support reality, but it cannot replace it. If the reality isn't there, the paperwork doesn't save you. And when participation is asserted based on structure rather than substance, the risk doesn't disappear. It just gets deferred. The consequences of this misunderstanding rarely show up immediately. They surface later, when income increases, when deductions are questioned, or when a return is examined more closely. Losses that were assumed to be active are reclassified as passive. Offsets disappear, carry forwards accumulate, and the investor is left confused because the strategy was described very differently at the outset. This is why expectation setting matters so much. Not to limit opportunity, but to avoid surprises. There's a big difference between a loss that is temporarily unusable and a loss that was never eligible to be used the way it was described. Understanding that difference early changes how investors evaluate opportunities before committing capital. Material participation is most defensible when there is real authority, real responsibility, and real operational involvement. That usually means direct ownership, active management, or legitimate control over the activity itself. It doesn't mean every tax advantage strategy fails. It means the ones that work reflect economic reality rather than narrative convenience. Control creates credibility, delegation creates passivity, and the tax code can tell the difference. Strategies that align participation with actual responsibility tend to hold up under scrutiny. Strategies that rely on labels, elections, or after-the-fact documentation tend not to. Material participation isn't something you opt into. It's something you earn through involvement. The strongest tax strategies don't rely on promises or paperwork. They rely on real activity, real risk, and real control. And once you understand that, you stop being surprised later. You start being intentional earlier. If you've watched all 3 videos in this series, there's one core idea that should stand out. The tax code rewards behavior, not labels. When structure reflects reality, strategies hold. When the tax benefit becomes the product instead of the byproduct, the structure eventually collapses. Knowing the difference before you invest is what separates smart allocators from expensive lessons.